Crisis indicators are flashing red. So, over the last couple weeks, there are many indicators that are flashing red in many different markets. I actually had to add a new slide in there because late Sunday night and now early Monday morning, when I'm recording this audio, I had to add in this slide because oil futures have completely and totally crashed again. So, as you can see on your screen there, we are now down almost 32% in only a few hours since oil futures contracts opened up. So the blood in the streets, the falling knife, is still no end in sight. We don't know what the VIX is going to open with on Monday when I'm recording this audio, but the VIX is now substantially higher than it was in mid-February when it was stuck around $14. Whack-a-mole back down anytime it got quite a bit above 14 for a very long time. So the VIX now, as you can see there on your chart, the VIX is being bought quite a few times above 30. People are buying the dips now, it looks like, in the VIX. And the VIX closed on Friday at 41.94. So when does the leverage short volatility trade blow up? When do VIX ETFs and the exchange traded notes blow up? Looks like Christopher Cole will be right. And unfortunately, there are a lot more naked shorts and institutional investors desperate for income, professional money managers and institutional investors desperate for income that have sold naked calls and leverage short vol trades on many other stocks and asset classes, hoping for income because of central bank financial repression. Grant Williams and Raoul Pal talked about this on one of the last Adventures in Finance podcasts a number of years ago before they redid the show, and Grant Williams stepped away as co-host. The Fed earlier last week did an emergency rate cut. This was the first time the Fed has done an emergency rate cut before a Fed meeting, which is normally when the Fed announces rate cuts. First time since 2008 and 2001. So you know things are bad. I think behind the scenes there is very, very bad problems in credit markets, in corporate bond markets, in high yield debt markets that we might not even know about. And I've been looking for news stories to cover this. I think the problems are probably worse. I think George Gammon is probably going to be proven right that at least one large bank is on life support, is already a zombie or on life support on repo. Maybe there's multiple long-term capital managements too, hedge funds that have also failed. Because in spite of these rate cuts, in spite of these games that these central banks are playing, the stock market is not rallying. In spite of the OPEC cuts that they tried to do early last week, the oil price still fell. And look at the new strategy the Saudis and Russia have. This exemplifies how what the central banks are doing is not working. This chart is from hedge fund manager Tavi Costa, who I've interviewed from Crescott Capital. He put out another chart a couple days before this one, but this chart is very interesting. Shows a number of these central banks doing absolutely massive amounts of emergency liquidity injection and balance sheet expansion in the last 20 days. And in spite of the $625 billion now increase in central bank balance sheet expansion in the last 20 days, markets are still falling. We still have futures markets opening up. The stock markets haven't opened up yet on Monday when I'm recording this, but the futures markets for the major stock market indexes are down 4% and 5%. When this video is released, we'll know more. But with the oil market, I mean, that does not bode well. We'll have to see what the central bankers, the plunge protection team, and others decide to do. But if what you see on your screen there is happening and it's not working, it's time for rules changes. It's time for even more drastic monetary bazookas and helicopter drops from the central bankers, and especially rules changes. This is Treasury yields. This was the Treasury yield curve on Friday from gurufocus.com. You can look up the yield curve for free there. And the yield curve has gone quite a bit inverted, especially at the front end of the curve to the middle part of the curve. So the curve is starting to really frustrate the Federal Reserve Bank members. Now, remember, they did do the emergency 50 basis point rate cuts, but the market is starting to price in additional rate cuts at the next March Fed meeting coming up in the next 9 or 10 days, I believe. And then also, I think the market is starting, according to the Jim Bianco Research and the Fed Fund Futures, an additional rate cut in April as well. There's a high probability for both. So this is starting to get really crazy. The market is starting to game the Fed and force the Fed into extra rate cuts faster. And you know what? It's not really working because the stock markets are not reacting positively to the rate cut news. Even these late stock market purchases 20 minutes, 30 minutes, 40 minutes before the stock market closes in the late afternoon is only painting the tape to make the tape look less bad. Turd Ferguson, Craig Hemke of TF Metals shared this. This is an unbelievable change in the U.S. Treasury, the 2-year U.S. Treasury yield in only 3 months. So this thing has gone down from above 1.4% yield down to barely above 0.5. Unbelievable. I've never seen anything like it, and I've been in finance now for 10 years. What this tells me is that a lot of professional money managers are not going to just risk off. They are going to extreme risk off. So they are going to cash dollars, maybe other currencies as cash, even though the dollar index is actually been in a pretty interesting correction for a while now. I think that's currency swap related for at least the last week or two. We may never know the truth about that with the currency swaps, how much dollars are being injected all over the place to try to put out fires and prevent things from collapsing. But very interesting here with how quickly professionally managed money is going into bonds. And I'm going to talk about this at the end of the short little video. There is a warning from one of the top bond investors, from one of the top bond specialists about people going into bonds. This is another chart of the 10-year U.S. Treasury yield. So here we were a year ago. We were at 2.63%, and we've collapsed now. I think we're way below 0.7% yield. And just unbelievable. I'm running out of descriptive words here. How crazy this all is. This is accelerating faster in the last 2 or 3 weeks in a lot of different ways, I would say, than what I remember happening in 2008. I do not remember a 2 or 3 week period being quite this crazy because China stepped in with stimulus and other things. We're starting to get to ridiculous levels of craziness here right before the 2008 collapse. This is a chart from Jim Bianco Research, showing the 10-year U.S. Treasury yield and the 30-year U.S. Treasury yield in only the last 5 weeks. So it's gone down enormously. This is a chart of the 30-year U.S. Treasury yield. And by the way, that 10-year U.S. Treasury yield that I talked about, that's an all-time low. It has never been that low before. So we're at all-time lows in Treasury yields, despite the U.S. Treasury issuing record amounts of Treasuries. That's how crazy and perverse everything is right now. So here we are with tons of managed money, professionally managed money, going into the 30-year U.S. Treasury, willing to lend the U.S. government at 1.215% interest. We'll see what the opening is on Monday for markets, but this video is being recorded before markets officially open on Monday. Finally, and I teased this a little bit earlier in the video here, this is an interview, a must-watch interview with bond expert, bond specialist, and billionaire Jeff Gundlach. So he did this interview in the last week, and he talks, and he's a bond expert, and he talks about how there's not really, with all this professionally managed money going into bonds and yields falling so low to all-time lows for U.S. Treasuries. And by the way, the spreads, there's problems in the corporate bond market, big problems. There's problems in high yield. The credit markets are freezing. So all bonds are not safe. But Jeff Gundlach says that the returns for U.S. Treasuries are going to be absolutely horrible, even with massive amounts of leverage, 10 times leverage or more. And he thinks that the returns for treasuries might be less than 10%, even with massive amounts of leverage. So he is recommending in this interview all cash for now, which is really crazy levels of risk off, extreme risk off, and gold. But he has talked many times about having a gold position, physical gold, and he also had a gold mining stock position. He's been a big investor in gold mining stocks in the past, talking about how they're a good hedge. Not sure if he still has gold mining stocks, but he did have a gold mining fund in the last couple years and was adding to positions on the dips. So this bond expert, this bond specialist, doesn't even like bonds now, especially the returns with all-time low yields. And he thinks that a lot of corporate bonds are way too risky and high yield debt is way too risky as well. So I've highlighted a bunch of different crisis indicators here, and all of them are flashing red. We'll see if the VIX is able to be whack-a-mole back down. It does not look like that, but maybe somehow, some way it will be. The Fed, anytime the yield curve gets too inverted, the Fed will want to cut rates if they still can. We'll see how many more rate cuts the Fed can get away with. They are these Keynesian economists at the Fed and academic Keynesians want negative interest rates. I hope to God that that does not happen. But all these other crisis indicators, the biggest crisis indicator flashing red now, and I had to put that chart in, was the oil futures dropping even more, over 30% in only a couple hours. So we'll see if that oil price drop holds. But it looks like the Saudis and Russia are going for the jugular. They are going for the kill shot. They are trying to totally bankrupt deepwater offshore drilling companies and U.S. shale oil producers that have higher costs and too much debt on their balance sheet and cannot raise a lot of capital. And then the Saudis and Russia will regain a lot of market share. And then a couple years from now, maybe 2 to 4 years, depends how bad the cerveza problem is, how long a recovery time everything takes, how long the global supply chain comes back online, how long oil demand from China comes back online, because we know that the Chinese are lying about the recovery. And then we're going to have probably, almost definitely, I would say, triple digit oil again, because the demand destruction now for oil, with China's economy slowing down and the travel restrictions, is going to cause supply problems both now and later, with oil prices crashing this much.